Hey everybody, what is up? Welcome back to Final Trade. I wanted to have a talk today about being careful about looking in the rearview mirror with your investing decisions. It's really a double-edged sword because to some extent you need to understand how cycles work, how markets work, and you can only do that by looking at the past. But on the other hand, you need to be careful that you're not looking too specifically at events in the past and imagining that they're going to repeat in the future. So I'm going to give you two stories here about this. So let's go back to January of 2020. Theros Beyond Death comes out, and less than a week after release, the expected value of a booster box falls to $50 to $60. And at the time, people wanted to blame these blasted new collector boxes. And remember, this was only the second set ever to have collector boxes, and there was a lot of conjecture that the mythic pool rate in Theros Beyond Death collector boxes was much higher than it was in the previous set, Throne of Eldraine, which was the first set with collector boxes. And the conjecture continued that because of that high mythic pool rate, it was crashing the expected value, and that's why it was in the $50 to $60 range less than a week after release. So then we go forward another year to the next January, and what do we have? Kaldheim, also a disaster at release. Kaldheim, January 2021, had an expected value. This is a set box just for demonstration purposes, but the draft booster box, 2 weeks after release, had an EV of $57. Again, you're asking card stores to pay the distributor $78, $82, $85 a box for something that only has $57 of value in it on the secondary market. You're not going to get players enthused about that. And so very, very bad introduction to both of these products, January of 2020, January of 21. And that brings us to now, January of 22 recently, and the first set of this year, Kamigawa Neon Dynasty. And so everybody looks back a scant 2 years and they say, I can predict the future based on 2 releases of Magic products. And they say, oh, Kamigawa is just going to be terrible. The EV will crash upon release, just like the previous 2 first sets of the last 2 years. And they bet against it, or they don't bet on it at all, or they decide not to take a position in it early on, or they just trash talk it on the internet, or, the outrage merchants create a bunch of videos complaining about how it's going to be terrible. Whatever. Take your pick. And then it comes out a week and a half ago was the soft release. This last couple of days was the, official final release. And what happens? Well, we're only a few days in, but the EV of a draft booster box, not a collector box, but of a draft booster box of Kamigawa is currently $77, which is really reasonable. I mean, a lot of card stores that have enough leverage can buy at that price from a distributor. And so when you're asking the players to potentially buy a box for, 90, $100 that has $77 of average value in it, and then has a bunch of variability on top of that, that's going to be a lot easier for players to stomach and not be turned off by how crappy the set is. And so from a value standpoint, Kamigawa looks like it's doing better. And the interesting thing specifically with these collector boxes is they were right at $189 on release day, and they've held there. And it's interesting, I've been watching TCG players sales, I've been watching sales on eBay and active listings on eBay, and man, they are holding on eBay $189. On TCG Player, for some reason, people are willing to pay $215 for the same box, whatever. But the price is really holding, and it feels like those dealers could be increasing the price. And so it definitely looks like Kamigawa has broken that pattern of the previous 2 years, and the first set out of the gate for 2022 is doing all right so far. Hopefully it continues. And so that's the first story about being careful about looking in the rearview mirror, because if you had strictly looked at these last 2 sets and you had made any conclusions, well, Kamigawa proved you wrong. But, there's probably not many consequences to that. The second story goes into commodities. And, these are things that are fungible, like oil and timber and iron and wheat and stuff like this, and hundreds of other things. But commodities tend to have what's called a super cycle. And so you will have a problem in it, and I'm going to use oil, generally oil, but oil also has oil and gas and refined products and all these other things, gasoline and diesel and all these other downstream products. And it also encompasses transportation via pipeline or rail or ship and all these other associated constellation of industries that go with oil and gas when people just kind of generally say oil and gas. And the whole huge collection of industries will have these super cycles. And what generally happens is companies will invest a bunch of money on exploration, which means they go out and they search for oil in the ground and they drill exploratory wells and they see how much oil do we estimate is in the ground based on all of our expertise and our measurements that we can make from the top side. And then they decide whether or not they're going to develop that area. They're going to put in wells and they're going to start pumping. And likewise, they may decide, well, we need more refining capacity, so we'll build a new refinery, which is no small feat. It takes sometimes billions of dollars and many years. Or we need a new natural gas port so that we can load natural gas onto ships and send it over to Europe where they're very cold right now. And all of this investment and all of this work to accomplish those things takes many years. And so drilling exploratory wells, building the wells to actually pump at commercial rates, building the refineries, it takes years and years and years. And so there's this huge lag between investment of money and revenue from selling the product to the final user. And in fact, that lag can sometimes be 3, 5, 6 years. It can be a long time. And this is what causes super cycles, because if currently the price of oil is really low, it dissuades companies from spending a lot of money on exploration and expansion and building up and making sure the supply in the future will be robust. And so when the price is low, they don't make those investments, and over time the supply slowly follows that trend downwards. The supply gets tighter and tighter. And so eventually that causes the price to start going up because now you have more dollars competing for the same barrels of oil or downstream products. And you end up with the price going up and up and up then. And so then as the price goes up and oil companies make more money, they will have more money to spend on exploration, and they will have more motivation to explore because they'll be thinking, hey, I can take this same barrel of oil that 2 years ago sold for $30 and today I can sell it for $91. And so they say, man, I'm going to pump all I can. Sometimes they say that. But you can see how this creates these long lags. And eventually they kind of get too greedy and they say, well, I can make all this money. I'm going to explore like crazy. I'm going to pump like crazy, refine like crazy, and just make all the money I can, make hay while the sun is shining. And they do that, but now they're pumping so much oil in the market that the price starts to go down and you head into the next part of the cycle. And so that's what a commodity super cycle generally looks like. And it can vary by commodity and by industry and by part of the world and all these other things. But the thing to note about this is you can very accurately look at the past of commodity super cycles, and you can make pretty good predictions about the future. And to give an example of that, in 2020, obviously we had a lot less demand for oil and gas products. People were staying at home. Planes weren't flying. Cruise ships weren't running. And so you were not consuming nearly as much oil and gas products as you had been previously. And because of that, the price of those products went way down because the demand just was not there. And because the price went way down, oil companies started to hurt. Their revenue was hurt. Their profits were really hurt. They were taking on huge amounts of debt to stay afloat. And they were cutting back on that exploration. And so we got into the time period of August, September, October of 2020. And it was kind of hitting rock bottom for the oil companies. And you would see all these articles in the financial press and talking about how, these oil majors, someone's going to end up going out of business and they're terrible investments and they'll never be worth anything, and all of this doom and gloom. And I sat there and I looked at it and I said, but this is just kind of it's a highly unnatural variation of the commodity super cycle. And oil and gas had already been in the downward part of super cycle since 2014, I believe. And I said, eventually all of this, the lockdowns will end. People will get on cruise ships. People will get on airplanes. Ships will start trading goods across the oceans again. People will drive their cars. They'll want to go on vacation. There will be pent up demand for that. And regardless, populations keep growing. And I said, this is not a good view of things, that these companies are dead. And so I bought hand over fist. I bought oil companies in August, September, and October of 2020. And today, what are we, 15, 16 months later? A lot of those stocks that I bought back then, they're yielding 8, 10, 12% on cost with dividends. And the stock value itself has more than doubled in most cases, because I looked backwards at the commodity super cycle and I said, if I look in the rearview mirror in this case, I think I can make accurate predictions. Where someone looking in the rearview mirror in this case was going to make highly inaccurate predictions. And the question comes down to, how can you tell the difference? And so I think the differentiator is, are you looking in the rearview mirror at a long-term thesis or a short-term guess? And what I mean is, you have these long-term theses that you use in your investing, and they necessarily need to be pretty small ideas that have big compounding weight over time. Things like I've talked about in other videos, like people will continue making more people. And so populations in emerging parts of the world will continue to grow. The middle class will continue to grow, et cetera, et cetera. That means that markets will have to continue to expand to provide for them. And that'll probably hold true for another 50 years. And that's the kind of good long-term thing. And that ties in with the commodity super cycles. A commodity super cycle is a long-term simple idea. It's that when you underinvest in production of the commodity, the price will eventually go up as the supply dwindles. And then while that price is high, companies can afford to invest too much in production of the commodity. And so then they overproduce it. And as time goes on, the market pays less and less. And so that's a predictable long-term thesis. With this, what you had was short-term emotional bets on narrow and unlikely events. People were taking 2 years worth of data, only 2 years. They conveniently just left off the first set of 2019. They went to the first set of 2020 and the first set of 21, and then extrapolated to the first set of 22. And so they took this very short-term view, and they made this somewhat emotional guess on what would happen. And it was that, well, there were problems here and there were problems here, and so there'll have to be problems here. And those things don't really follow. You don't have this logical chain of events, like underinvestment leads to underproduction, leads to high prices, leads to overinvestment, leads to overproduction, leads to low prices. And so this was entirely an emotional connection that people were trying to imagine between these products based only on short-term data. And so that's where you can get in trouble looking in the rearview mirror. And the real challenge as an investor is figuring out when to look back, when it's going to be useful, and when you are deceiving yourself. That's a really difficult thing, and it comes with experience and wisdom and a lot of trial and error and a lot more error on top of that. So let me know what you think. If you have any interesting stories, any ideas, any questions, I'll make a video for you and answer them. And if you like this kind of content, like, comment, share, and subscribe. Join me on Final Trade. I'd love to have you. Thanks a lot.